I want to get right to it today. No holds barred. The main reason why many of us don't get our blessings is because we don't give enough. Let's start being better givers than receivers. Let's see how that works out. I know how it works. Once you get the giving down, you start receiving. The giving is for you, not for them. With that being said, we need you to hit that subscribe for us and the like button. We put in a lot of work for this content and it's extremely valuable. This content will change your life. So help us out. Hit that subscribe so we can take our valuable time and give you this billion-dollar content. Thank you. Strap up. It's game time. Let's get it. Okay, here's the game plan. For this first clip, I really want to get you an idea of market conditions from some other experts so you hear it from them just as well as me. Oh, and guess what? Watch the whole video. All subscribers that make a comment in the comments section get a chance at free stock. We're going to do a live drawing with all my subscribers. And that's when we're going to do the giveaway. Pick your favorite stock symbol, whatever company you want, type it in the comments section and put the coinciding number beside it. So if you're the first subscriber to put one there, put 1 beside your name. If you're the third, put a 3. If you're the 15th, put a 15. If you're the 100th, put 100. Let's go. Let's get it.
Warren Buffett says a real estate storm is coming. Over $2.6 trillion of debt looming over the U.S. real estate market. And by the way, Warren Buffett is dumping stock as we speak. He's dumped most of his Bank of America stock. Should tell you that he knows something that you need to know. So what does Warren Buffett know about the marketplace, the stock market and the real estate market that you need to know? Look, guys, there is a real estate cataclysmic correction happening today. There's $2.7 trillion. And I'm going to share with you how you can take advantage of it, what you need to do about it. But when guys like Warren Buffett and Charlie Munger and Bill Ackman and people are starting to watch this marketplace and say something is going on in the marketplace that's problematic, it needs to be paid off somewhere between now and the next somewhere 20 months from now.
On the 9th of December 2024, we posted a video warning that the stock market was due for a short-term pullback. Since then, we've seen the S&P 500 correct by a few percentage points, and the RSP, an equal-weighted version of the S&P 500, correct by about 7%. The question now is whether we can already start being more optimistic on the performance of US stocks, or is there more pain to come before US stock market indices finally bottom out? There's 2 reasons for why the stock market is been declining recently. The first one is simply portfolio rebalancing. Back in early December, you used their exposure. Now, while these high levels of exposure don't guarantee corrections by any means, they certainly do increase the odds that one will happen. When we look.
Okay, I showed you what some experts are saying. I showed you some technical analysis. All right, here's a little more. Don't go nowhere.
Since the last crash in 2009, share prices have risen 300%. Most Americans may be living paycheck to paycheck, but Wall Street is booming. By any metric, US share prices are now overvalued. Share price to earning ratios have reached record levels, higher than just before the dot-com bubble of 2001. The US stock market is now over 200% of GDP, 4 times that of the early 1990s. In early 2000, shares in tech firms soared to crazy income multiples. They said this time is different because the new technology was the internet. But when the bubble burst, the Nasdaq fell 77%.
Okay, so gave you a little bit of info about the bubble. Gave you some info about the Trump effect. Stay dialed in. Here we go.
Barry Bannister from Stifel.
17th to chart.
Finally, we have a bear. Someone says stocks are going to fall, right? And I think when you dig into what Barry's saying here, of course, if someone's telling you that stocks are going to fall in 2025, they're probably going to talk about valuations, right? They're going to talk about how that puts maybe this market rally on a little bit of thinner ice. But what I think is interesting is what Bannister's getting at is something that is becoming a little bit part of the discussion right now as far as sticky inflation probably leads to less Fed rate cuts. And then the real kicker is, a weaker economy. So one of the things we've talked about with all of these bulls and the large thing that people feel like is going to go well is a better than expected US economy. That's been the trend since post-pandemic, is the US economy has grown better than consensus. Well, Bannister thinks the US economy probably grows at about a 1.5% annualized rate in the second half.
How does he get there, Josh?
It seems like overall, it's the impact of higher rates too, Josh. Remember, we're going to come back to that conversation, I think, in 2025, that eventually holding rates higher for longer does something to the economy. It hasn't to this point. That recession that we talked about for 2 years has not come, but there is still a take out there that at some point that's going to happen. He's talking about the consumer here. Consumer spending would slow down, then your economy slows down. And this reminded me, guys, of a chart that we highlighted a week ago in our Morning Brief newsletter that Lori Calvasina shared from RBC on how markets do in different GDP regimes. So if you look at GDP over time, here you go, 1.1 to 2%. So that's Bannister's range, right? That's when the S&P.
Okay, I gave you info on valuation. I gave you info on rate cuts. Gave you info on slowing economy. I gave you info on, and I gave you info on not factoring in risk. Here we go. For those that would like to contribute, you can hit the pause button if you like. Here's our Cash App, and we appreciate everything you do. This is what we've been waiting on right here. It's the money part. Get ready. This is the setup for success right here. Bases loaded, grand slam. I'm talking about walk-in touchdown, slam dunk, however you want to look at it. Setup for success. Let's get it. Write this down. Inverse ETF. Inverse ETFs, baby. This is where we score big.
Inverse ETFs are basically a way to win in a recession. If you guys are anything like me, you're probably trying to avoid checking your investments every day because you just don't want to see that negativity in your life. It's not fun opening up your trading app and seeing -5%, -10%, whatever it may be. It's definitely been a bloody start to the year. And honestly, pretty much everybody is in the same boat. People are losing left and right because all major indexes are down. The S&P 500 year to date is down almost 20%, and the NASDAQ is down almost 30%. So really, no matter where you go, you're probably losing money. So with losses piling up in all of these major indices, where can you put your money? A recession is potentially right around the corner. Maybe we'll get some news for the second quarter of this year and potentially could be in a recession, if not probably headed towards one later this year or maybe even early next. So if that's the case, you're probably a little bit worried about all that money that you have saved away in S&P 500 index funds. However, had you invested in inverse ETFs to start this year, you could be up 30% instead of being down like probably most of your friends who are invested in just traditional equities. One thing real quick before we actually get into what inverse ETFs are, how can you invest in them? Is it a good idea or a bad idea? I put a lot of time into these videos and a lot of research, so all right, let's get into it. So probably the best way to start this video is to explain just what exactly is an inverse ETF. Probably sounds a little bit like a weird name. What is this? Is this some strange investment opportunity? Yes and no. So an inverse ETF is an exchange traded product that tries to do the exact opposite of what a traditional ETF or index fund does. And an index fund seeks to track the performance of any given index. So like the S&P 500 or the NASDAQ or the Russell 2000. An index fund seeks to match exactly the performance of that index and not try to beat it or not try to underperform relative to that. And an inverse ETF seeks to do the exact opposite. So as a good example, just to quickly explain what an ETF is, if you're not familiar, the most popular S&P 500 ETF is called SPY. And again, this fund seeks to track the performance of the S&P 500. And probably the best way to understand what SPY does and what an index fund does is imagine it's like a giant pie with 500 different slices. So it's the 500 biggest companies in the country by market cap. And all of these pie slices, the 500 of them, are gonna have different sizes. And each of those sizes vary on a daily basis, depending on how valuable each of those companies are. So some of the biggest companies you've probably heard of, obviously like Apple and Amazon, have a much bigger slice of the pie than some of the smaller ones that are maybe ranked 500th or 499th. And on a daily basis, those values are changing. And so SPY is also trying to match that. And so the percentage of one share is going to hold a little bit of Apple, a little bit of Netflix, a little bit of Google, and then a very, 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 very small amount of whatever the 500th ranked company is at that time. And so this is actually where the inverse ETFs come in. So they look at that pie with the 500 slices that the SPY is tracking, and then it does the exact opposite. So essentially it's taking a short position, or it's betting that all of those stocks are going to lose value. So to understand how this works, if you have $100 of SPY in your portfolio and then $100 of an inverse fund to that, you have $200 total dollars in your portfolio. No matter where the market moves, up or down or sideways, left, right, you're always going to have that $200 in an ideal world.
You heard it here first. Who else is telling you these types of things? Here's a little bit more info before you go.
Welcome to the channel. Well, there's no missing it these days. Warnings of the coming recession and the stock market crashing every day for the past year is all over the news and your YouTube feeds. But I have some good news for you. You don't have to lose money in markets like this. It's true, you can make money in red stock markets. So in this video, I'm going to show you exactly step by step what inverse ETFs you can buy with a click of a button that actually make money as the stock market is crashing. And so one way to make money in a market like this, when everything else is crashing, when everyone else is losing money on stocks as they fall, is to go short or to buy an inverse ETF. And what going short means is that you're betting that stocks will fall in price. Normally this would mean that you have to borrow shares of a stock inside of your stock brokerage, but I'm going to show you actually an easy way to go short on the stock market, going short an entire index without taking risky loans or going out on margin. And you can do this just by buying something called a short ETF and buy and sell it, trade it like a normal stock. These inverse ETFs are almost the same as normal ETFs. The only difference is that these are short rather than long, meaning that when the index they track loses money or goes down in price, a short ETF goes up in price, meaning red days are green and green days are red. Now, why would you buy a short ETF? The main reason a lot of investors do this is because unlike when you borrow a stock to go short, with an inverse ETF, it's impossible for you to personally get margin called just by holding these ETF shares normally, and you don't have a risk of losing an infinite amount of money. The worst that could happen to an inverse ETF is that the price of the ETF per share can go to zero, whereas if you're shorting a normal stock, you could potentially lose an infinite amount of money. This is because if a stock is worth $100 and it goes to zero, well then you've only lost $100. But if you go short a stock betting that will go down and the stock prices increases to $1,000, you just lost $900. That's the difference between $1,000 and $100, meaning you lost more money than you went short and invested in the first place. And as you can guess, on the stock market, stocks can only fall to zero, but in theory, they can expand or blow up to infinity and go up in price. That's why many investors prefer short ETFs, so that way they still don't have that chance of losing an infinite amount of money. The first inverse ETF you should know about is SH. The ProShares Short S&P 500 is probably the most popular inverse ETF, and the reason a lot of investors buy this inverse ETF is that it gives you a negative 1x daily return of the S&P 500 index. So for example, if the S&P 500 index were to drop by $1, this ETF would actually go up in price by $1. Because this ETF pretty much bets against the S&P 500, which is an index of the largest 500 companies on the stock market by market capitalization. In layman's terms, the S&P 500 is just the top 500 all-stars biggest US companies. So meaning that if you buy SH, you're betting that big companies like Apple, Microsoft, Amazon, Alphabet, and Tesla, and Johnson & Johnson, all the big companies on the S&P 500, are going to go down in price. SH has an expense ratio of 0.89%, meaning that for every $1,000 you invest in this inverse ETF, you'd have to pay about $8.80 in fees. So for comparison, a normal ETF like SPY, which tracks the S&P 500 normally and is not inverse, that expense ratio is actually just 0.09%. So you can tell that the management fees in inverse ETFs are more expensive. Now these fees are automatically deducted and are reflected in the share price of the ETF, meaning that you won't actually see the money you're losing in fees go out of your account, but it's important that I make you aware of this, just so that you know what's going on in the background. So given that the market has been falling and crashing pretty hard recently, you're probably smart enough to guess that SH has been doing well, but the question is, how well has it been doing? As of this video's release in June, the S&P 500 is down 19.9%, while SH is up this year 21.2%. So for an easy comparison, if you had two stock trading accounts, each with $10,000, and one of your stock trading accounts you invested all into the S&P 500 ETF SPY, because you wanted to invest long-term in the S&P 500, as of this video's release, you would have just $7,715 left of your original $10,000 investment, even if you reinvested all of your dividends. Now, if you bought SH with your other trading account because you wanted to go short on the S&P 500, thinking that those 500 companies would go down in price, your $10,000 investment would be worth $12,570, gaining you $2,570. This is just a snapshot of this moment in time as I'm recording this video, so do your own research, and these percentages could easily...
The play is in. Now it's just about execution. Do your due diligence. Do your homework before you make plays. Okay? Study the ETF of interest. Be careful. If you got any questions, let me know. We got another one in the books. Appreciate you all. We're going to have more valuable content coming your way.